Broadcasting from beautiful, tropical Vero Beach, Florida, it's Money Nation with Ed Gardner.
Good morning, and welcome to Money Nation. Today we've got Joe Cunningham from Worldview Capital on the line. Joe, welcome with Money Nation.
Thanks, Ed. Great to be here.
We had Joe on a couple months ago, and if anyone wants to go back and listen to Joe's original interview, you can always feel free to go to YouTube and search Money Nation channel or Money Nation Ed Gardner, and all the old shows will come up, and you can hear in full about Joe Cunningham and Worldview Capital. But we got Joe on again today. Joe, what's happening in the world today?
Well, I'm going to start with a word of caution. And, we've got Memorial Day is behind us, and 4th of July is fast approaching. The issue is fireworks. Fireworks getting from China to the U.S. has become a real bottleneck. So I would just like to encourage all your listeners that if they want to have fireworks for the 4th of July, to go out and get them now. It's just a nice little way of illustrating a macro theme, which is it's taking now about 3 weeks to get containers through the port systems in the United States, and that is historically at its longest point ever. In addition, freight for a container, you fill it in China or wherever you're filling it, and you ship it over. Those prices have gone from about $4,000 to between $10,000 and $12,000. So there's a shortage of containers on the Pacific side, and meanwhile, the demand is coming into the U.S. at record paces. South Korea just in May had its biggest export year ever, which is saying something when you think of the juggernaut that South Korea is. Now, I bought a new television in May, a Samsung, so I did contribute to that, but it is at record levels, and the U.S. consumer is doing what the U.S. consumer does best, shopping, spending.
That's for sure.
If we stay on that pace, we could find our own GDP growth trending up, and I think that is probably the reason that the OECD, the Paris-based Organization of Economic Development and Cooperation, they raised their global growth estimates from 4.2% to 4.2% to 5.8% for 2021. That's a big jump. So we're getting COVID, behind us. U.S. consumers are showing up in size, and it's creating some bottlenecks, but it's also presenting some opportunities, especially for investors.
How has the GDP grown so much in the last 10, 15 years? I think maybe 10, 15 years ago, Joe, correct me if I'm wrong, the GDP was like 4 to 5 trillion. It's 21 trillion now, and we've got debt of about 28 trillion. How's that happened? Yeah,
so a lot of it has been easy money. Since 2008 in the quantitative easing, right? We rolled that into QE1, QE2, the quantitative easing that the Fed was implementing, and then we just kept printing money. So the inflation rate has been low because of the supply chain efficiencies that are coming mainly out of Asia, but South America as well. And the economy has grown at a pretty good clip consistently for 3.5, 4% a year. There doesn't much change. We saw a little bit of a increase in growth when Trump, the year he cut taxes. That was a bit of a pop. But other than that, it's been remarkably consistent. So it's just growing on its own pace, and I don't see anything stopping it. We'll see some eye-popping numbers coming out, year-on-year comparisons, because last year was so bad. So this year is going to be so good, and you'll see, kind of stupid numbers, right? They're just out of, they're not consistent with any growth trend. And you kind of saw that with the inflation number last month. If you remember, inflation was up 4%, and everybody freaked out. Well, it was up 4% from the year before, when it was down 3%, because it was more deflationary during COVID. So, there wasn't much of a panic. And if you remember, we spoke about the how we look at the TIBs, the 5-year inflation protected treasuries, and they're about where they were the last time we spoke, Ed. So I'm not too concerned about. Yeah, pretty steady. Ticks up a little bit, ticks down a little bit. Everything is just kind of on that flat plane that we'd like to see. So I hope your investors are, but I'm generally feeling pretty good about where things are globally, and in the U.S. The truth is, I don't really work very hard, except for the last day of the year and the first day or the last day of the month and the first day of the next month, right? So that's today.
That's a good way to do it. It's a good way to do it.
Well,
Joe.
We rebalance our portfolio on a monthly basis, and so we've got to see what's going on and how it's a little bit early. And I took yesterday off like the rest of the American, so we're just kind of trying to wade through the numbers right now. But the U.S. is still pulling the rest of the world behind it, which is right where we want to be. Really, we're leading the world. The market is up over 25% since the election. So the calls that your 401k was going to crap out if Biden got elected just has not been true. So, but again, we're in that too much money chasing too few stocks scenario, and PEs are up. And not to disparage any stock, but my wife bought something on Wayfair this weekend, and I said to her, "Oh, they're on my short list. Stocks to short." And but I hadn't really looked at it. I looked at it, and it's at a PE of 65, and it has performed okay. If I had shorted it when I had the idea to short it, I would have lost. Just kind of going sideways. So, but things are looking good.
What about the debt? We did the $6 billion package, took the total debt, U.S. debt, from like $21 trillion to like $27 trillion.
Yeah.
That worrisome to you?
So,
are they just going to keep going to 30, 40, and $50 trillion in debt? How do we pay that off?
Here's, they're going to raise taxes. That's how we're going to pay it off. And they're going to become much more efficient. So there's a couple of points there. One is that tax rates will go up on high income earners, right? So that's you, Ed, and I'm not really there, but you and your clients are going to pay for some of that. And corporate rates are going to be normalized, consistent across the globe, right? So one of the things that's happening that's an interesting trend is this global minimum tax rate. Now, I will take you back to the 1920s when we had what we call a beggar thy neighbor theory, right? Which is every country was racing to devalue their currency. And that was really a great cause of the Depression, right? It's countries, Germany would devalue, and the U.S. tried to keep it steady with the dollar tied to gold, but then the U.K. would devalue, and all these countries devalued, and that led to a depression, which led to a war. So what we see now is not the currency devaluations. We see the tax rate devaluations, right? So these countries, and especially the Caymans and Ireland and Jersey and some of these countries, they keep minimal taxes. And so the U.S. has proposed, with the OECD again, a regime where they will police these countries' tax rates. And they'll have some type of tariff or some type of barrier for companies that are racing into these jurisdictions to pay no taxes. So they're going to be very efficient at collecting taxes. Biden says he's going to put $80 billion into the IRS. I don't know what that buys you. It sounds like an awful lot of money, though, on tax collection. But to your point on the GDP, the debt to GDP, that's a tricky one. And I want to caution your listeners that is a much manipulated and often used for political purposes because you can manipulate it. So what is debt? Is it all the contractual obligations of the U.S. federal government, or is it the state governments as well? Is it household debt? How you define that is pretty tricky. So your number's a little higher than ours, but that would be a function of the definition, and politicians will use that definition to their advantage, whatever's convenient for them. But it is going to get bigger. I would say, just generally speaking, and we look at everything on a relative basis, the U.S. has been underinvesting in a lot of areas. So we're playing a little catch-up. Eventually, that pendulum will swing back, and taxes will come down, and spending will decrease. So I'm not too concerned on it right now. I'd like to see some spending on infrastructure if that's where it goes. I'd like to see, the U.S. taking a little bit more leadership role in the world economy, which we seem to be doing. So I'm not overly concerned with it until it becomes an issue. So how would you know it's an issue? So inflation would be one, but there's two types of inflation. I think this is interesting. There's a bond market inflation, right? So the bond market one day is going to sell off, and yields are going to spike up. And so right now the 10 years is 1.64%, right? So if and markets like traders like a little volatility. You know that as you're a trader, sometimes it's not a bad thing. So there will be a headline number or something. It could be oil related. It could be geopolitical. It could be a lot of things. And we will see a spike in interest rates. And that might not translate into the real economy, right? That's a bond market inflation indicator, right? So the bond markets can spook the regular markets. And if rates go up, and let's say it's geopolitical or it's an oil shock or something like that, then the market will tank, and it'll be blood on the streets, and maybe it's a good opportunity, as Rothschild says, to buy. So it's I'm not overly concerned right now with any of that, and I think it's a really interesting time globally for investors and for consumers alike as we start to see a surge in demand and a fairly placid inflation environment.
What about people that think the only way to get rid of $20 trillion in debt is to devalue the dollar? If you devalue the dollar by 20%, you have 20% less debt. If you devalue the dollar by 50%, you wouldn't have $20 trillion in debt. You'd have $10 trillion in debt. What do you think about that type of thinking? People don't want to hear that. They don't want to see their 401ks, IRAs, and everything else dollar denominated go down 50%. You think the government would ever try to do that quietly, and that would be one way to get rid of debt. What do you think about that?
Well, that would be the worst way to get rid of it, for sure. But I'm not saying that we're not doing that. So as you and I have discussed before, I follow the dollar index very closely. And so what I'm starting to see when I look at it over the last year is what I call a bipolar world, right? Where you're seeing an appreciation in the yuan, the Chinese yuan, right? It's up about 10% over the last year. And we've seen about a 10% depreciation in the dollar. Okay, so our biggest holder of dollars is China. So they're kind of taking it on the chin here as the dollar index broke through the 90 handle maybe just last week or the week before. It's in the 89 range now. It had been during most of the Trump administration up in the upper 90s, and was an issue for me when we were trading gold mainly down in South America. And now it's come down. It's below 90. And at the same time, the yuan is up at like 635 levels. So it's appreciating. The dollar's depreciating. And I just wonder so this is kind of an interesting time for geopolitical geeks like me, because if the yuan continues or stabilizes, and China's taking a number of very interesting steps to address their internal deficiencies with debt and state-owned enterprises and things like that, we might see a shift out of dollars with the ASEAN countries in particular. They're the Southeast Asian, the former Tigers, Singapore, Malaysia, Thailand, Myanmar's in there, South Korea. They're all those countries there might start to shift to more of a Chinese yuan currency basis, and that would be profound. So the U.S. wants to be careful how it does depreciate. And again, as I mentioned before, that beggar thy neighbor theory comes in here, where you're racing to the bottom. And it's beggar thy neighbor because you're taking from your neighbor, basically. to satisfy your own internal dynamics. So I don't think we'll see anything dramatic, but we could continue to see a slow drift here in the value of the dollar.
Joe, we're going to take a quick break here. Remember, clients, remember listeners out there, any questions at all about your portfolio, always feel free to give me a call. You can email me at edgardner@cutterco.com, and you can always feel free to give me a call at 518-255-8854. We'll be right back with Money Nation.
All opinions expressed by Ed Gardner and or his guests on the Money Nation show are solely Ed Gardner's and or his guests' opinions and do not reflect the opinions of Cutter & Company or any of their affiliates. You should not treat any opinion expressed by Ed Gardner and or guests as a specific inducement to make a particular investment or follow a particular strategy, but only in as an expression of their opinion. Ed Gardner's and his guests' opinions are based on information he considers reliable, but neither Cutter & Company nor affiliates and or subsidies warrant its completeness or accuracy, and it should not be relied upon as such. Always talk to your financial advisor before making such decisions.
Welcome back to Money Nation. We've got Joe Cunningham from Worldview Capital here. Joe, let's talk about inflation a little bit. I saw articles about the prices of people seeing chicken, meat, kind of skyrocketing. By the way, a future guest the next week or two, we're going to have Dave from Fred the Butcher. Fred the Butcher is a legendary butcher in upstate New York, one of the biggest purveyors of Wagyu beef from Japan. And we're going to talk more about specifically the meat industry and good steak, which I know you like, Joe. But what's your feeling on not only prices of meat that kind of like skyrocketing, but gas? I just drove out to St. Louis and back, and gas prices were just crazy. What's your thoughts on that?
Well, good point. First of all, I had 4 porterhouses grilling up yesterday for my wife and her family, and it definitely cost a small fortune for me to feed those guys this year over, say, last year. You get older, and all of a sudden, choice cuts aren't really cutting it any longer, and you start buying prime. The next thing you know, dinner's gone from $50, $60 to $200. So that was my yesterday. And I also filled up my tank this morning, taking my son to school, $50. And so I thought, well, how did that happen? And sure enough, the West Texas Intermediate, the prices moved up into the $66, $68 a barrel, and that influences everything in the economy. So that's going to be interesting to see how that gets handled as we go through the course of the summer. There doesn't, I know that OPEC is meeting, but there doesn't seem to be any global issues there for supply. So, sometimes markets drift up because they can. And in this case, I haven't looked at, the number of rigs that are in service or, those things that we sometimes look at in a while. But I haven't seen any supply disruption. So I would expect this is kind of a soft number for oil, that's $66, $68. Meat prices, it's kind of funny because, you listen to the climate change people, and they want eating less meat. But, when you were driving through St. Louis, for example, or Iowa, south of me here, there's no slowdown in meat production. That's for sure. So we are seeing it in in our area as well. I'm in Minneapolis. We're a big farm to table kind of state, and we're definitely paying more for pretty much everything. What's always troubled me is when you get the CPI, the Consumer Price Index, for example, they'll take out food and energy because of the volatility. That's what I spend my money on.
I know. That's always bugged me for many, many years, how anything that goes up, they take out of that inflation index. It's really, it's kind of fake,
Kind of meaningless at times. Absolutely right. Yeah, I mean, what am I spending to heat this house in January? It's not cheap. That's where I'm spending my money is on energy, and to feed my family. We eat well, and we will spend money on food. That's one of the areas that we will not cut back on, and it's starting to feel it.
I was in dinner in Lake George on Sunday night, and one of my guests or one of my friends I was eating with, he started going through the menu and saying, "Hey, this was $9.95 last year. It's $12.95. You know, the French onion soup was $7. It's $9." Right across the board, like 20% in this one restaurant. And 6 months later, they're charging that much higher. You know, back to meat again. Is this the demand so high for meat, or are the costs with raising the cattle going up? And that's why the prices are coming up. Well, what do you think about that?
Right. Well, commodity prices are definitely moving higher. There's no doubt about that across the board. So
grain for the cattle, you're saying, and gas
for everything.
To keep the cattle, and the tractors and all that, or
yeah, you bet. All that is impactful on, you know, ultimately what the prices are. But I wonder if at restaurants, if they're paying their people a little bit higher wages as well, because they're having a hard time, you know, really getting people to come back to work at a
huge problem.
Yeah, huge problem for sure. And there was an article in the paper this morning that it's the best time ever for teenagers to get jobs pay, because they're having to get these kids. Like my son works at McDonald's, gets $15 an hour. He's 16, and they give him free food, and they give him, you know, it's kind of a funny one. Prices have not gone up at McDonald's, I can say that, but that's not really our jam. It certainly is his, and about $15 an hour for a 16-year-old kid, that's pretty good. That's a pretty good wage. So I wonder if at the restaurants, if maybe they're having to pay the people a little bit more.
I think you're exactly right on that. The wages are probably definitely more. Let's talk about the sector rotation. You know, growth was the big winner last year. Now we're seeing value outperforming. How do you think that's going to roll out? How do you think that's going to continue for the rest of the year?
You know, I watched the Berkshire Hathaway meeting because that's how boring my life is. And it's dreadful.
Yeah.
And the worst part is actually the Q&A section, because you have these big institutional investors, and these are just people that are, you know, they're not, they don't seem like they have much fun. Now maybe you can say that about me watching them, right? But it was they were having a bit of a moment here recently, and they've earned it. And I still think, you know, and we all got a little seduced by the technology sector, right? You know, it was really humming along, and if you weren't in it, then you were just missing it. And, you know, we do mostly ETFs here, and, you know, we jumped into a few, and they did really, really well. Now, some of them come down recently as Tesla's kind of fallen, and but, you know, even Tesla's, you know, bounced around. The volatility on some of those stocks is tremendous. But we think that, you know, overall, the technology is, you know, we're entering that fourth revolution. So the technology sector is going to stay relevant to, you know, what we're doing here. And so we're going to stay with those stocks ourselves. On the value side, I you know, there's a rotation of what is value and what isn't. You know, do you want to own Coca-Cola or General Electric right now? You know, maybe not. It is a, you know, one of those classic Buffett value plays, right? So we're going to have to define what value means in a industry that has a, you know, inflated price to earnings ratios and other value indicators, right? So it'll be interesting to see how things move as we get into the summer. But I do see, you know, looking at the charts today and looking at where the markets are at, feeling pretty groovy.
Yeah. Kathy Woods, who was one of the best performing funds last year, her ARK investment fund, you know, high technology.
I love that.
Did very well, was the best performing fund, not so well this year, but she's sticking by her guns. She says this is the future. This is what's going to happen over the actually next 6 months, for the next 5-6 years. And she goes, these are the companies that will grow. And even though they're pulling back now, she likes them. And you feel the same way over long term?
So we bought more of that last week. And it's at 110 right now. But their big component is Tesla. So you want to be a little careful that you're not overweight Tesla, because it can be, you know, very volatile. And if you own both ARK and you own Tesla, then you're probably overweight Tesla.
Yeah.
But we, so that's one of the ones we like. And when I don't know if you remember, but I was advising at some SaaS companies a couple of years ago, and that really opened my eyes to that sector. So the Shopify's of the world, and some of the even Oracle and Salesforce and some of those. That's the new business model, having that recurring monthly income that we pay. You pay Microsoft or Google for cloud storage space every month. It's not a lot, but when you get 1 billion people paying you a couple bucks a month, you're doing okay in that sector.
It's a good business.
That's a good business model. It is. So that's what we all need to come up with, an idea for a SaaS company, because it's easier than ever to get people to plug in and buy your buy your service on a recurring basis, and from that you can make a small fortune. We see it, and what we focused on in those early companies were bootleggers mainly, and these were guys that were trolling away in their basement, coming up with something in the education space or in scheduling or some such thing to make your life a little bit easier. And we would buy those companies, or the fund I was advising, we would buy them pretty cheap. And these guys would be a life-changing $1 million payday for them. But what they're selling is a lifelong stream of revenue, right? Because once you kind of sign on to those things, it's not too often you sell them. Are you going to not store your photos on the cloud? No,
yeah.
You're going to.
Well, we had the internet, then we had cell phones, then we have the cloud, and now we have AI, which is the fourth new frontier, which is starting. Let's go back to, we got another minute or two, Joe, but let's go back to Berkshire. So what did Berkshire Hathaway, what was the main theme or the focus on that call?
Well, I think the main focus was on the transition to the new management team, to be honest with you. And we don't own any Berkshire, and I don't see myself really jumping out in front of it. But the main theme was on racial justice, climate change. They want audits on those things across the portfolio. They want to have audits on to see, what the composition of the workforce is, and what a report on what the companies are doing to manage their carbon footprint. All those big macro themes you see on the nightly news were coming up and being put to the management group, and I don't think they're that interested in those issues, to be honest.
Right, they talked about
I think Buffett's view is the Milton Friedman view, that if I can make you money, then I can, I'm doing my part. So
that's what his job is, right?
That's right. That's a job.
Joe, thanks for being with us today on Money Nation. Great talking to you. We'll have you on again soon.
Well, good. Thank you. I enjoyed it, and always good to get caught up.
Definitely. Remember, listeners, any questions about your portfolio and investments at all, you can always feel free to give me a call at 518-255-8854, or you can email me at edgardner@cutterco.com. And remember, listeners, any of the old shows you'd like to go back, you can always go to YouTube. All these interviews are on YouTube. Go to YouTube. You can search Money Nation channel or Money Nation Ed Gardner, and all the shows will come up. Again, Joe, thanks for being with us today. And listeners, have a great day, and thank you for listening to Money Nation. Have a good day.
Thanks, Ed.